On today's show, the annuity update for February 2014. Part one of this week's News You Can Use with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Welcome to the show, Mike.
Thanks.
I want to talk about, there's so much going on in the annuity market, and there's nothing that moves faster in our business than annuity rates, new ideas coming out from carriers. But before we do that, I've noticed that the treasury rates, the 10-year rates now, the long-term rate, bankrate.com, you're starting to see them kind of go up a little bit. What's going on?
Well, for the first time in I don't know how many years, the 10-year treasury peaked its head above 3% late in December, which gave a lot of people a little bit of angst, but at the same time it gives us an opportunity to widen that margin from the CD versus the fixed annuity rate. I mean, we have rates at 2.5 right now and for 5 years, and that benchmark 5-year CD is still well under a half a point. So we continue to widen the margin. We've seen good carriers like Western and Southern raise rates as much as 50 basis points on the 5 to 7 year period. So it's a good time to look at the fixed annuity marketplace for a variety of reasons.
Well, we've naturally, in my experience, we've always compared CD rates to annuity rates, but one thing that I saw you point out, which I think is a huge issue, is this issue of rising interest rates as it relates back to preservation of principal. Talk a little bit about annuities now compared to maybe a bond portfolio.
You're exactly right. It's a huge issue, especially with FINRA right now. They had issued an investor alert about in the third quarter talking about the concentration of bond portfolios in a rising interest rate market. When you take a look at a 1% interest rate rise, just 1% on a 10-year note, that will have an effect of almost a 10% price depreciation on that bond portfolio. So we're at a point where our yields are just equal to a 10-year treasury right now. So you could go into a 5 to 7 year annuity and not have the price depreciation in a rising interest rate market. So it's a great time for advisors to take a look at that bond portfolio, maybe sweep some of that money off. And since over the last 30 days, we've seen the 10-year treasury go from 2.84 to as high as 3.04. We're starting to see some of that price depreciation, and clients are calling saying, what's happened to my 1231 statement?
Well, you have a nice piece on this too, do you?
Yes, yep. And it works on all types of different, the shorter periods, you're not going to have as much price depreciation, but if you're in a long bond scenario with advisors trying to capture a lot of yield over the last 3 or 4 years, there's a lot of long bond positions out there, and that price depreciation can be even greater than 10% for some of the longer durations.
Shifting gears a little bit, I mean, this is affecting the rates go up. Now all of a sudden, Index has more money to buy larger pieces of the pie of options. Talk a little bit about that, and then shift me to this Barclays, because the last time we did a show, they had just rolled this out. It was welcomed huge in the advisor community, but I've seen these numbers take off. Talk a little bit about that.
The Barclays, again, continues to grow momentum. We had our largest month in 2013 in December with Allianz, largely because of the Barclays index being in the preferred platform. We wrote almost $10 million in one single month, which again was
just on their annuity.
Just on their annuity. And I would venture to say probably 90% of that went into the Barclays index. It's a very unique feature in terms of indexing. It has no cap. Which we've been living in a world of 5 to 6% caps for years. It does have anywhere between a 1.5 to 2% spread, but when you look at the historical average of the Barclays, it's been way higher than any annual cap. But what it does is on a daily basis, takes a look at the volatility and manages the volatility through an allocation of the S&P 500 and the Lehman Brothers Bond Index. And that allocation right now stands about 60-40, but may change a little bit. But it's a great way for an investor to get into almost an asset allocation scenario with no downside risk.
When I'm thinking about the index market having no caps, I got a small spread. That isn't too big to me. Just to make sure we're doing full disclosure, I have an expense load for this though. I have to pay for the actual permission to play in this regard. What is that number?
Well, inside the index, the carrier hides that, so it's really just the surrender charge. So when you're taking a look at point to point, you're getting the full value of the index minus 150 basis points.
And is that the spread or the cost of the
spread?
See, to me, I wanted to make sure we were clear on that, because to me that's a big difference, because we're not talking about a spread and an expense load to do this. Right. It's one spread, that's it.
Exactly.
I want to shift gears a little bit. I want to talk about this thing that you really like, and I found when I first heard it, I'm thinking, why is Mike talking about this? Mike's the annuity guy. Temporary life from Integrity. Tell me why you're playing in this.
We really like this play for a variety of reasons. It is a 10, 15, 20 year, even a 30-year period certain. But if the client passes away before that end of the period, then income stops. Where we think that it's a great play is with Social Security planning, so that you can push out your RMDs to 70 and a half. You can push out your Social Security payment until 70 so that you maximize your Social Security. But it's also a great way to fund life insurance and long-term care with like a 10-pay money guard, because you can set up a 10-pay, be guaranteed to have that payment, but if you die early, then the payments stop. The advantage of that is that it's significantly less premium. We had a case study that we can show you where a client was looking at about $320,000 to do a period certain. With temporary life, it was just around $300,000. That person used that $22,000 difference to put a down payment on his vacation home in Arizona. So it can make a huge difference when you're talking about creating leverage with clients.
I love this idea, and I want to kind of pick up on that right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. Mike, I want to talk a little bit about the idea of certain period certains, because in this Temporary Life by Integrity, you were talking about period certain, and is that making a comeback? Because generally the mantra out on online right now really is lifetime income you can't outlive. Is certain making a big 10, 20-year, 30-year lockdowns?
I think one of the things that a lot of advisors have to think about is looking at some old products in more innovative ways. We're seeing a lot of concern about Social Security, about how do I maximize Social Security. So we're seeing a lot of advisors use a period certain from age 60 to 70. And that way that client doesn't have to take their Social Security until age 70. They can defer it and they maximize their payment, and that payment then is indexed for inflation. So you're indexing a larger Social Security payment. So we're finding advisors looking at old traditional term certains in a new and innovative way to maximize income in a variety of ways.
So if I'm hearing you right, you're using it for a transition piece before I trigger my RMDs, before I trigger my maximum Social Security at age 70. And that's a tactic.
Absolutely.
Well, let's talk about that for a second. When I'm talking about income spreadsheets right now, of course, the interest rates have been pretty depressed, but if the 10-year treasuries are going to go up, I'm wondering if I'm going to get any play on increased in single premium immediate annuities or some of these income riders that give you a little bit of flexibility. Have you seen anybody in the SPIA market for income actually start moving up a little bit on the interest rates?
Yeah, we've seen real small, steady increases over the last 4 months with increased payouts. And obviously there's a blip here and there, but for the most part, we've seen steady increases. But we find that a lot of people are using the lifetime income with 20-year certains and things like that. What we think is an innovative idea with temporary life is to take a look at the person's life expectancy, and let's say that that's 25 years. Do that temporary life with 25 years. That way the amount that they need is probably about 20% less than a traditional SPIA, and then you can wrap around some of your other assets under management or use a deferred immediate for past 25 years. So we just try to get advisors to take a look at more creative ways to create leverage for the client, to maximize income, and also a lot of the lifetime incomes that we're using, we're really taking a look at some of that 3 to 5% COLI riders. You start out less, but when you take a look at life expectancies here in the U.S. of growing and growing and growing, and our healthcare getting better and better, chances of you living well past your life expectancy have increased substantially over the last 20 years. So that inflation protection, whether it's through an income rider or whether it's through a SPIA with a COLI, probably needs to be looked at very seriously.
And remember, you can see all this. We have a, I think, to die for income spreadsheet that maps all this out by age. I like to see those numbers. It really shows your income possibilities. And I like the idea of people using combination annuities now, DIAs, SPIAs, deferred, indexed. When I'm looking at it, I noticed that you have a really hot piece out right now on fixed rate versus indexed rate. And that's something, of course, we can give our advisors. Talk a little bit about that.
Yeah, when we take a look, even as great as the disparity is with CD rates versus fixed annuity rates, our best 5-year rate is still about 2.5%. If you take a look at the historical average, of even with a 5.5% to 6% cap rate, let's forget about the advantages of the Barclays uncapped rate for right now. But if you take even a capped indexed product, the likelihood over a 7-year period of that maxing out a 5.5% cap is about 80%. So when you take 80% of that cap rate, you're still going to average significantly more than that 2.5% 5-year MYGA account. So now the client's going to see maybe some zeros throughout that 5 to 7 year period, but at the same time, they're going to probably, historically speaking, have a better return in an index versus a straight MYGA.
I know this is a difficult thing to postulate, but if I took the lost decade, I had 4 out of those 10 years that lost in the S&P 500. Would I have still been better off, still in a 10-year maybe indexed, rather than the fixed interest rate?
Yeah, absolutely. You still would have been, because even in that lost decade, there was some recovery, and you had some times when you maxed out the cap, and people have to remember that even though that you have a lost decade where you have a 40% loss, all the way back up, you're getting that gain. Even though you may be less than what you started, you're still getting some of those positive returns year over year, and that's the real unspoken advantage of an indexed annuity.
Well, I like the power of being able to bring that up. I mean, this is the worst 10-year period in our lifetime, to be sure. And if I'm saying in 2001, 2, and 3, and 2008, we had S&P losses. So I'm not getting anything credit to my annuity. But even then, the other 6 years were able to overcome that and beat the fixed interest rate market. See, that to me is a very encouraging thing.
Yeah.
I mean, I don't know how many decades we're going to have like that again.
Yeah, hopefully not too many.
Not too many. But to me, that's a very good pressure test to say, here's my argument. You have a piece on this, and of course, that's available to all our advisors.
Absolutely.
Do you see anything coming up? I know there's some carriers coming up with new product, and we'll talk about this next month to really when we roll out. But give us a little bit of kind of a little bit of a peek view.
We're seeing carriers with increased interest rates have more capacity for research and development and for expansion of product lines. We're seeing additional index options, commodity options that will be introduced. We're also going to see additional options on the floor to come out in terms of protect the client relative to their cap rates and things like that, so that they will have more liquidity built into the product.
Well, that's our show for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. See you.